And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, the second best day of the week, and that means that we also had earnings last night from Meta and Microsoft, way better than expected. Those stocks are going to be up sharply this morning. Both Meta and Microsoft up about 9% this morning. That's going to drag the entire index up with it this morning. Futures pointing up about 1.25% this morning at the open on the S&P. Now, again, how we finish out the day, that'll be a different story, but we'll talk about that some more. Then don't forget, tonight we have Apple and Amazon. So those are going to be really important for the kind of the consumer look. How is the consumer hanging in there? And speaking of the consumer, talk a little bit about yesterday's GDP report that came out. GDP came in a little weaker than expected yesterday at negative 0.3. And but that was almost entire. I mean, while that was worse than kind of expectations were for about a 0.5% print. That was almost entirely driven by the import-export imbalance, right? That trade deficit. And that's a function of all this front-loading that we had with people going out buying stuff, basically businesses in particular. If you take a look at the inventory build for businesses and business investment into inventory, those had very big jumps. And of course, that big import drag, that net exports weighs on GDP, and that's what actually gave us the negative print yesterday. That's likely going to get revised away over the next month or two. Again, that first estimate is just the estimate based on all the estimates from Wall Street. So over the next 2 months, as the data comes in, we'll get a revised estimate of what GDP actually looks like for the first quarter. That's likely going to be revised up some, because once you got underneath the surface of that report and actually looked at the report, personal consumption expenditures was very strong. Business investment was strong. Actually, the report outside, if you just strip out what was going on with inventories and just set that aside for a moment, the actual report itself was generally positive all across the board. So really no sign in that report of any type of recession. It was simply a function of this front running of tariffs that's now over for the most part. So we're likely going to see GDP improve in the second quarter here somewhat. And again, because when you take a look at personal consumption expenditures, which makes up about 70% of GDP, that was very strong. Also on the positive side, PCE, which is the Personal Consumption Expenditures Index, came in flat. Both headline and core were zero prints, which actually led core to have one of the bigger declines that we've seen in terms of core PCE in a while. That's going to ease some of the pressure on the Federal Reserve to cut rates, right? Because there's no sign that even with tariffs that we're starting to see an inflation increase across the board. So when the Fed and particularly the Fed looks at trim mean PCE, that's their measure for inflation. And again, we take a look at what was happening with consumption. And if we were going to have a big inflationary push from tariffs, we actually would have seen it in the last quarter, because again, you had all this activity of people going out to buy stuff ahead of tariffs, which applied price pressure because you had a lot of demand relative to supply. We saw import prices increasing, etc. That did not translate through to the actual consumer index for inflation. So again, when we take a look at that data all across the board, it was actually pretty good. No sign of a recession, and there's certainly signs that inflation is normalizing back to where it should be relative to where economic growth is. So again, economic growth would be weaker even if we stripped out that import-export number. GDP report was still weaker than the 2.5% prints we were pulling out last year. But again, it's not recessionary. And again, the data really wasn't recessionary in that report yesterday. So again, good news there. Earnings are still doing okay right now so far. Earnings season has been very strong. Buybacks are now starting back up. As of Monday, we'll have basically the full window for S&P buybacks will be back as well. And that brings us to the market, which is actually having a pretty good morning this morning. here's what you need to know before the bell. I'm actually going to pull through a couple of different charts today, so we're going to move kind of quickly this morning. But again, as we kind of talked about yesterday, the good news yesterday in particular, because we did start out a little bit weak in the morning, is that the market is still holding on to this. It got above this kind of this resistance level before this morning. In particular, we're going to take out the 50-day moving average. So this open this morning is going to pull us above the 50-day moving average. So we've now taken out this 20-day moving average. We took out this resistance that was previously here, those bottoms, kind of the pre-tariff. We've taken that resistance level out. We're going to take out the 50-day today. So the good news is that sets us up for a rally up to about 5,700 potentially. If Apple and Amazon have good earnings tonight, then that's going to give the market this ability to push up here towards 5,700. But that's where we're going to run into the 200-day. You got the 100-day sitting right above it. So again, there's a good bit of resistance here. Now, importantly, we've had 7 days of advance in a row. That's a fairly long streak in terms of market advances. So yesterday, Mike and I added to our short position in the S&P 500. Again, it's just a hedge for downside risk here temporarily. But the expectations is that we're certainly going to get this rally today, maybe a little bit more tomorrow, but you're going to get a pullback somewhere. And the good news is that when we get this pullback, this previous kind of these bottoms are now going to start to act as support. So we've got some initial support being set up here for a correction. Again, markets are starting to get a little bit overbought here. We're not grossly overbought on a momentum basis, but markets have been doing well here. So expect, potentially after today, tomorrow, early next week, that you're going to get a little bit of a relaxation here in the markets. Markets probably are not going to retest these lows, but a retest of kind of that previous set of bottoms around 5,200 would not be a surprise at all. Now, one thing that we talked about previously is that when you started getting this rally in the market's going to start looking for sources of liquidity. And that source of liquidity was, as we kind of talked about previously, was going to be gold, because gold has been such a huge winner here during that whole kind of corrective tariff period. Gold was a very, very big winner. And so you had this very big sharp rise in gold prices. Everybody got very excited. We talked about that's going to be the source of liquidity, because this is where all the money was hiding. It was coming out of bonds because of the basis trade, coming out of the stock market because of the tariff trade. And so since that, now that the markets are recovering, people are selling gold here to go back to buy other assets, so stocks and bonds. You triggered a MACD sell signal from a very, very elevated level. You're not oversold yet on the basis, so you've got downside risk right now in gold to about 3,080, somewhere around there. That will probably give you the best entry point if you want to try to add gold to your portfolio. Start looking for support around the 50-day moving average. That's been a good level of buys, actually kind of going back here for a while. The 100-day is sitting down there as well. That's around 2,900. So somewhere in that range will probably get gold oversold enough to add it to your portfolio, et cetera. So if you're looking to add to your position, let this kind of correction process play through. You've got a very elevated MACD sell signal there as well. So that's going to give you a better opportunity to pick up some gold at cheaper prices. On the other side, oil is starting to look very appetizing here from a buy basis as well. We've gotten very oversold here, taking out some lows this morning. So we talked about before is that oil prices could get down into the low 50s. That's very possible, but you're getting decently oversold here. You've had a pickup on a sell signal. You're very oversold. This momentum sell is coming at a very, very low levels. So looking for somewhere around probably mid 50s to low 50s. You're probably going to get a decent entry point for oil prices as well. So, think about energy stocks as well in your portfolio. But you're getting a really oversold condition in that commodity. So at some point, the sellers are going to get exhausted, and you're going to get a rally in oil prices as well. But that'll also coincide with the dollar in that position. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. We'll talk all about what's up with yields lately. Been all over the place. We'll talk about where they're going to next, coming up next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Lebowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Lebowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Lebowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is, of course, Thursday. That means that Michael Lebowitz is here. So I will just turn it over to him now, and I will see you in about 47 minutes to wrap up the show. So,
piece of cake, Lance.
Piece of cake. You got this. So a couple of things here to kind of just talk about this morning in terms of, what's been going on with yields. I've been getting just tons of questions. It was interesting yesterday, just in particular, the PCE number came out. Personal consumption was really decently strong in yesterday's report. Really no sign or evidence that the consumer is slowing down to any great degree. And I immediately got a bunch of emails following that saying, well, did this mean that yields are going to go, soaring higher? Because if the consumer is just still, being really strong, that means inflation is going to go back up. And that's not how it works. But, there's been so much volatility around yields lately. We you and I discussed at length talking about the basis trade here recently because we saw that very big spike in yields. That's now mostly been reversed. Yields are back down to about 4.1%, 4.1.5. So we've mostly reversed. That whole basis trade scare seems to have settled down here. But, again, there's still just, lots of concerns about, where yields are going, what's happening. And just so I thought we'd spend some time this morning just talking about, some of the misnomers that are running around, trade deficits, the fact that we've got to refinance $9 trillion of debt this year. That's certainly going to send yields higher. I just thought we could just go through some of these narratives this morning and talk about what really is going on in the bond market, what drives the bond market, is there a risk of default on debt, those type of things. And so let me just throw it over to you real quick, just get your kind of opening thoughts, and then we'll just converse from there.
So there's a few concerns for the bond market. One is deficits, and we can get to that one a little bit later. I think the one that's kind of more driving the market right now are tariffs. And what's the impact on tariffs on bond yields? Not from a deficit, but from an economic perspective. And there's this narrative going around that tariffs are very inflationary in aggregate. Mm-hmm. And there's also a narrative going around that the longer that this tariff war goes on without agreements, we're going to have a recession. And to some degree, both of those are true. If there's a tariff on cars coming in, some of that tariff will get passed through to customers, whether it's 100% or near 0%. We don't know, but someone is eating that cost. And inevitably, some of that will fall on consumers. But that's just one side of the story. And what you don't see is the consumers that have to buy less of a car, the consumers that don't buy a car, the other products that people can't buy because they bought a car. So there's many inputs into inflation. And based on history, it's not clear that tariffs are inflationary for the whole basket of goods.
Right.
There are certainly goods that will rise in price.
Can we hold that thought real quick? Because I think that's such an important point when you start talking about specifically the CPI report, right? So everybody watches the Consumer Price Index report. Every time it comes out, there's just this massive bunch of narrative, one way or the other about what it means and, what's going on with CPI. But let's actually just kind of break down, to your point, Mike, let's just break down the CPI just real quick here and talk about where tariffs are going to impact the CPI report, right? So housing makes up 44% of the index. How are tariffs going to impact housing prices, right? How are tariffs going to impact rent? Transportation, tariffs are going to potentially impact the automobiles, but what about the oil prices? Right, because we don't import a tremendous amount of it. We do import oil, but not a tremendous amount. We manufacture a lot of it here. So when you start actually looking into, and this is to your point, Mike, when you actually start breaking down the CPI report, start looking at recreation and apparel and those type of things, there's some certain points in the report that will be impacted by tariffs, but where those tariffs have the most impact on the CPI report, they're the smallest factor of the CPI report.
Well, and there's all the substitution effects.
Correct.
Right. So maybe we're going to get, this is a friend of mine brought this up, that we're going to get avocado inflation because of tariffs with Mexico.
Right.
That may be true, but maybe people start eating broccoli, and maybe we're going to
George Bush.
maybe broccoli is deflationary. Right. So shifting consumer preferences are going to shift, and will they shift to goods that are lesser in price? Will they, so it's just so hard to know. And then I think the bigger effect is kind of what you were alluding to. It's the energy. Energy is in everything.
Right.
Energy is not just used to put in your car or fuel airplanes. It's in everything. And energy prices are plummeting, right? I mean, what were they I want to say almost 90 9 months ago.
Right.
And now we're kind of
56.
dealing with the mid-upper 50s.
Yeah, 56
They broke below 60 yesterday.
Yeah.
That's a huge input. Interest rates are a big input into consumption. And yes, they've come down, but they're still very high. It's really hard still to get a mortgage. I mean, it's really hard to buy a house because mortgage rates are so high. That affects new homes and existing homes, and the ability for consumers to extract money out of their mortgages via equity loans. Right. So there's bottom line is we can focus on avocado prices, we can focus on lumber prices from Canada, on chips from China, but it's all those other items that no one is focusing on, and the general strength of the economy, which we got the GDP report, and like you said, Lance, you mentioned that well, the economy is not growing at minus 0.3%. But if you kind of strip out the import-export and you strip out those the private inventories, it's probably growing in the upper 1% range, which is good. It's not a recession.
Right.
But it's
not great.
Right. It's not great. It's trending lower, but it's not a recession. But that will negatively impact prices on the margin.
Right. And let me bring something up here real quick, because there was a comment in chat, which is a correct point. And his point is that, once prices go up, they never come down again. That's a very true statement. And they don't. And this is why when you talk about inflation, what does the Fed want in terms of inflation? They want 2% inflation. That means that every year, the price of whatever you're buying is going up 2% every single year. You want inflation. You don't want deflation. Deflation is a negatively growing economy. So the Federal Reserve, the government, you as a consumer, you want rising inflation to some degree, because that's what keeps the economy going. That's production, that's manufacturing, that's jobs, that's employment, that's demand, that's all those things. So yes, prices never go down in terms of that. So again, we're never going back to 25 cents a gallon of gas that I paid in 1972, right? So I mean, just not going to go back there. And so this is why, when you look at inflation, you have to understand this, is that when we're talking about inflation, we're talking about the year-over-year rate of change in inflation. So if the price of, a gallon of gas is $3 this year and it's $3 next year, inflation is zero. You can have negative inflation. It can go from $3 to $2.90 over the next year, and that's a negative inflation rate. But overall, for when the economy is growing, you're going to have some inflation as a function of a growing economy. So yes, prices never go backwards unless you're in a fairly good recession that's causing price reversions because of a real deterioration of demand. So go ahead,
Lance. That's a good point. And here's something to consider along those lines: is that we are an economy built on leverage. So hypothetically, let's just say house prices drop 50% today. Almost everyone that owns a house with a mortgage would be underwater. There would be an incredible number of defaults because everyone's underwater, and if they can't make their payments, they default. The banking system would go under. Now consider the whole economy is leveraged. It's not just house prices. It's corporations, it's other loans to consumers. If asset prices were to drop, and I'm not just talking about stock prices, I'm talking about assets in general,
right,
were to drop that much, the economy would be gone. And that's what happened in the Depression. We had 25% deflation, and we had, a horrific almost 10 years of pain for this country. So inflation is here to stay, but it's inflation at a 2% rate. But there will be points in time where it goes up more, and we're kind of stuck with that. But you have to look at what wages are doing too. It's not fair to just say inflation is up without looking at wages.
Right, and that's why when we go back and now let's shift this back to yields here real quick, because this is where our conversation is that if you take a look at where wages are, where economic growth is, and where inflation is right now, yields at 4% is about where they should be, right? So as things begin to slow, we have more wage deterioration. If the economy continues to slow, you're going to have, basically wage deterioration. That's less demand in the economy, and economic growth is going to slow. So when you look at those, that's all going to bring inflation down towards the ultimate where the Fed's target is, which is around 2%, because that's where everything will be at that point in terms of supply, demand, and balance. But when we come back from the break, we're going to talk about some misnomers in the markets, and particularly this whole idea that we have to refinance $9 trillion in debt this year. It's great for bearish headlines. Nothing true about it at all. We'll come back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Lebowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Lebowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Lebowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I've never seen so many economists and financial people become epidemiologists in my entire life, right?
It's a Christmas miracle.
I know, right?
If your choice is death or listen to Lance Roberts, I'm sure I might win at least 20% of those.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, Mike, welcome back to the show this morning. So, Michael, you know why they call birds that fly over the ocean seagulls?
That Lance.
Because if they flew over the bay, they'd be called bagels.
But I need a little drum set here for you.
Exactly. That's for Richard.
I'll save that for Candid Coffee.
There you go.
A little drum set.
Yeah, he'll have plenty for you, I'm sure. All right, so let's talk about one of the big misnomers running around right now is that it's interesting. I mean, like if you take a look at videos out of just, I was looking at our YouTube chat just a minute ago, and below that, there's a whole list of videos out. Top one is GDP goes negative, recession coming. You got to be careful with all these headlines that are out there because a lot of them are being put out with people either have an agenda to try to sell you something or just trying to scare you to get views, whatever it is. One of them is this: the government has to refinance $9 trillion in deficit this year. Oh my gosh, that's going to mean interest rates are going to go to the moon because of that refinancing. Most of the people that are running around that are claiming this to be the event, right? That's going to, just disrupt the whole bond market and collapse the economy, whatever it is, lead to default. Have no idea how the bond market actually works. So, be careful who you're getting information from, and particularly when it's just some kind of, voracious headline to try to scare you into some, type of outcome. Just be really careful about what's going on. But there's a few things to understand about the bond market, and I'm going to turn this over to Mike here real quick. But just remember one thing is that the interest payments on the debt Okay, this has nothing to do with the refinancing, but also part of this is the interest payments on the debt. Are interest payments on the debt rising? Yes, because we have higher interest rates. Interest rates are a part of mandatory spending in the budget. It has to be paid regardless of anything else. So we will not default on our debt. When interest payments are due, and this is the whole big thing about the debt ceiling debates and all this other stuff, the interest payments always get paid. If there's going to be cuts, it'll be cut in areas of non-mandatory spending, such as Department of Education, Health and Human Services, those type of things. Those are not part of mandatory spending. Social Security, Medicare, Medicaid, welfare, veterans benefits, those get paid. That is mandatory spending that has to get paid. We will literally print money. And that's the benefit of issuing your own currency. And this is where the Eurozone really kind of screwed themselves up by not having a monetary structure underneath their decision to have this unified currency. But that's the one benefit of the United States, that we have the ability to print currency if we need to. And I'm not saying that printing currency is a good thing, but we can print money literally to pay our debt if that's needed. So this whole idea we're going to default on our debt is very erroneous. And that's one of those things to set aside. But this does go into this whole idea of trying to refinance. We have to refinance all this debt. If we can't refinance it, the country's in huge trouble. It's not really the issue. Mike, I'm going to give it to you, then I'll throw in a few more points here. But let's talk about the refinancing for $9 trillion this year. How's all that going to work? How's that going to happen?
And Lance, it doesn't even, money printing doesn't even need to be brought up.
That's right.
Because you have captive buyers. You have that there's $9 trillion of bonds that are maturing this year, right? Mm-hmm. By definition, those $9 trillion of bonds are Treasury bills. They are very short term to maturity. Now they are owned by money market funds, by banks, by people, by corporations, by foreign countries. They are owned by fixed income holders. Those bonds will mature. And when that bond matures, the government will reissue a bond. And it's likely going to be a 3-month bond, a 6-month bond, 1 year, 2 year. There'll be some 5 years, 10 years, 30 years. But you're basically taking bonds away from bondholders. Bondholders now don't have bonds because they mature. They need to have bonds. Money market funds.
Hold on real quick, because that was such an important statement you just made, but you missed one part. Yes, the government takes away the bond from them, but gives them all of their money back. So right. Now they have cash and their final interest payment, but they have no bond.
Right. So they have cash. So they can do one of two things, one of many things, but one of two things are most likely. They can either buy a new bond or they can sit in cash, right? If they sit in cash, the cash is really in a money market fund. It's sitting at a bank who acts like a money market fund. They're going to put the money to work, or it's sitting in an actual money market fund, which by definition has to own a ton of Treasury bills. So even if you're sitting in cash, your bond matures, you're sitting in cash, that money is going back into the Treasury market. Most institutional investors, when their bond matures, will go back into Treasury bonds. There's a reason they're in risk-free assets. It's not going to go from $9 trillion isn't going to mature and everyone's going to say, hey, let's go buy NVIDIA. That's going back up again. That's not what these investors are. These are investors that have chosen to be in fixed income. Not to say there won't be a couple. Mm-hmm. There may be a few, but when you say there's $9 trillion, it's a scare tactic, because there's also $9 trillion of buyers that they don't mention that as soon as those mature will be buying.
Yeah, and again, we just talk about that in particular. It's like, I've got cash sitting in my bank account right now. It's not invested in T-bills. Yes, it is. Because when your cash is at JP Morgan or if it's at Bank of America or whatever, they're doing fractional reserve lending. So you deposit cash, all you have is an account register. There's no cash. Your cash is not sitting at the bank. It's just basically a digital entry that, Larry Smith in our chat has some cash sitting in a bank account somewhere. That's all it is. It's just a ledger entry. The bank has taken that money. They've bought bills with it. They've bought bonds with it. They're capturing the spread, because that's, if you think you're getting, like, I've got my money sitting in a money market account at the bank. That's great. What do you think it's invested in? It's invested in T-bills, and they're capturing the spread between what they pay you on the money market rate and what they're collecting off the T-bills or the bonds or whatever else they're invested in. But that's where that yield on your money market account comes from. So when you think about all the people that own bonds, target date funds, mutual funds, pension funds, institutional funds, endowments, corporations, I already said pension funds, but corporations. Warren Buffett has $300 billion in T-bills. So when Warren Buffett's T-bills mature, is he not going to buy more T-bills? Of course he is. And when he gets his cash back, he's going to turn around and say, I've got cash. What I'm going to do with it, I'm going to buy the next bill up. And basically, they're going to roll their money, especially in funds that require the holding of bonds. And there is a tremendous amount of pension funds, mutual funds, target date funds, et cetera, that have to own bonds. So there is a consistent set of buyers for those bonds. But let's talk about one more buyer, Mike, which is the primary dealer. When these bonds mature and they have to be reissued, the government is going to go out and say, okay, we're issuing, and by the way, let's just clarify one thing. These $9 trillion worth of bonds are maturing every day, all year long. Right? This isn't like some event that on August 15th, there's $9 trillion due that has to be refinanced. It doesn't happen on one day. It's happening every single day. It's been happening since the beginning of the year. It'll happen through the end of the year. And over the course of the year, we will have refinanced $9 trillion in debt. But when,
let me stop you.
Well, real quick, the primary dealers have to buy the bonds, period. So there is a guaranteed buyer for those bonds when the Treasury issues them. Go ahead, Mike.
I was just going to say, let's just say $9 trillion matured today.
Yeah.
Let's just assume this impossible scenario where $9 trillion matured today. Mm-hmm. It would be a little sloppy. I'm not saying yields wouldn't spike up and down. They'd be volatile, but it would not be a problem. Within 2 weeks, that paper would all be absorbed primarily by the end users. Wall Street, to your point, would play a big role in taking down those bonds and holding them to wait for the end buyer. But again, you've taken bonds from 9 trillion people that need to own bonds. So even in this unbelievable scenario where 9 trillion hits the market, it's not the end of the world, as some would say about 9 trillion over the course of a year. And I think the bigger aspect of it is interest rates. And this is what Besant and Trump have been talking a lot about. It's not necessarily about the debt itself. It's about the interest rate they pay on the debt. And that's really what's important. So, we can look at what's maturing. Well, some of what's maturing are 1, 2, 3-year notes that Janet Yellen issued a few years ago at higher interest rates. So now they're actually going to refinance at a slightly lower rate. Some of it is called 7, 10-year bonds that were issued at very low rates that now is going to be at a higher rate. Some of it is 30-year bonds that were issued 30 years ago at a slightly higher rate than where we're at now. So, you're also looking at the net aggregate change in interest rates, which will go up. But there are certainly a lot of bonds, especially recently issued Treasury bills, which everyone's talking about, that many of which were issued at higher rates than we're at today.
That's right. So again, but this is the whole point of this is that the way the bond market works, and this is the important thing to remember about the bond market, is there's 20 primary dealers. When the Treasury needs to issue debt, they go to the primary auction. The primary dealers have to buy the bonds. They sit on the bonds, they season them, and then they start selling them off to their end users, which are institutions, pension funds, etc. Or the Fed. When the Fed's doing QE, they're the buyer. So, there's always a buyer for these bonds. And this is one of the big misnomers in the markets is like, oh my gosh, this refinancing of this debt is just going to destroy everything. No, it's just a function of the bond market. It happens every day. There's nothing about this. All right, we'll come back. We're going to talk about one more aspect to higher yields and what's been going on with yields lately. We'll talk about the basis trade. What happened? Where are we now? And where yields are likely headed to next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Lebowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Lebowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Lebowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So recently there was a big spike in interest rates that had everybody very concerned, very short term. And again, rates had gotten back down below 4% when just initially started this whole kind of tariff issue had started. And then all of a sudden, rates spiked up to 4.5%, and then in very short order started coming back down again. And a lot of that was what we talked about, was this basis trade where a lot of leverage in the system, particularly in the bond market. There's a tremendous amount of leverage, and when things move in the wrong direction too quickly, it causes what we call basically margin calls, or a forced unwind, is that people have to cover that outstanding leverage. And it caused a very big spike in rates. People were having to sell bonds in order to meet margin requirements, et cetera. That seems to have passed for the most part. Yields have been coming back down, and things seem to be normalizing in the bond market. But Mike, kind of what's your take here? Do you think that risk has mostly passed at this point? It seems to have quieted down a good bit.
I think it's a volatility risk. The more volatility you have in markets, the more margin the counterparties will require you to post. So when you need more margin, you need liquidity. So when the markets were, bonds and stocks and other things were very volatile, margin requirements were rising. It didn't help that asset prices were falling too. Mm-hmm. But you put all that together, and we were starting to slip below ample liquidity, as the Fed calls it. And it was certainly on the Fed's radar. They had mentioned it. So I think the answer to the question is this roller coaster ride over? No. But will it be as volatile? We'll see. And I think some of it kind of feeds itself. The more volatile it gets, the more liquidity becomes dear, and it creates problems, which creates volatility. So it's a self-serving circle. But things have calmed down, both stocks and bonds. Bonds are interesting. If you look at what's happened this year, it feels like yields have gone up, but their 10-year yields are down 45 basis points. And short-term bond yields are down even more, about 60, 65. But it's been hard to see that decline in yields. Sorry, I got a frog in my throat. Because they've been all over. We've had days where they've been up 10 or 15 basis points in yield, down 10 or 15 basis points, and it kind of clouds our judgment. I mean, even us who are kind of used to looking at big changes in yields over time, it's been kind of remarkable.
And again, it's just, this is, kind of also part that kind of gets lost in the mainstream kind of narrative as well, is that, there's a lot of focus on the day-to-day movements of interest rates. And again, it's always kind of interesting. It was, interesting yesterday, yields were up a bit, after the GDP report, which is actually yield friendly, but yields had moved up on, initially on the stronger than expected PCE spending side of it. Incomes and spending was fairly strong. And so yields moved up a bit. And immediately, people are like, well, why are yields moving up today? And it's just, a lot of the day-to-day movement in yields has nothing to do with anything. It's just positioning within the bond markets. And, it's easy to kind of get lost into the day-to-day volatility. But again, when if you're holding if you own a bond, you're going to hold that till maturity in theory, because that's how you get your principal back. Now, if you're trading bonds and that's your business, that's a different story. You're trading volatility and you're trading movements, overbought, oversold, those type of things. But, typically if you're a bondholder, you're owning a bond for capital preservation and you're collecting an interest payment. So if I can get a bond yielding 5% and hold it for, my 10-year period or whatever it is, I'm going to make 5% a year, right? So that's why I own a bond. But ultimately, the day-to-day movements don't mean a whole lot in bonds. It's ultimately going to be driven by economics that we talked about earlier. Economic growth, wages, and inflation. That's what's going to drive yields, because yields are going to reflect what the borrowing costs are within an economy. And if the economy is slowing and wages are falling, there's less demand for loans. So yields have to come down to find buyers. It's just like anything else in the markets. It's always based. Yield is a function of supply and demand ultimately. And that's driven by what's happening in the economy. So, again, it's kind of not worry so much about the day-to-day movements. A lot of times the day-to-day movements have nothing more to do with anything other than just, bond movements within the bond market based on, shorts versus longs, buyers versus sellers, those type of things. And it has nothing really to do with, the price of sliced bread at the end of the day. Mike?
Right. No, I mean, what have we heard all year? Tariffs are very inflationary. Tariffs are going to bring inflation back up to where it was. Tariffs are going to create a repeat of the 1970s. And what have bond yields done? They've gone down all year. So focus on those larger trends. That's what the market's telling you. Any market, stocks, bonds, you name it, gold, whatever it's doing day to day, minute to minute, has nothing to do with the fundamentals. It's when you draw it out over the longer term that you can kind of see what the market, again, it's not the fundamentals, but what the market thinks of those fundamentals. And when you get big movements is when there's an adjustment between the kind of narrative or the estimate of fundamentals and you get actual fundamental results. You get actual trend changes in the economy or corporate earnings or whatever it may be. And that's when you kind of get some shocks to markets. So, again, why did the price of IBM just tick up by a quarter? Who knows? It was a buyer that really wanted to buy and no one really wanted to sell. But if you want to know why, look at IBM over the last 5 years, it tells you a much better story about its corporate earnings, its revenue, its outlook, about the company itself.
That's right. And again, our nemesis is going to be up 10% this morning, by the way, after reporting very, very good earnings after the bell yesterday and also cut a deal. Interesting, CVS. I'm talking about CVS. CVS is going to be up about 10% this morning at the open. Beat estimates, hike guidance. Interestingly enough, they are pulling out of the Affordable Care Act market. So one of the things that has been a burden for healthcare companies has been the Affordable Care Act. So they're actually pulling out of that market. And they're also cut a deal with Novo Nordisk, which is weighing on Eli Lilly, where CVS is going to promote the Novo Nordisk compound that's Z-bound is their GLP-1, which is the competitor for Eli Lilly. But So kind of good news there this morning. But the stock's going to be all the way back to where it was in 2023. So it's basically getting back losses from the last 2 years finally. So outside of that, Mike, there's a lot of stuff going on within the markets. We had Microsoft yesterday. We had Meta yesterday. Those earnings came in much better than expected. Guidance was good. Forecast for CapEx spending was strong. This is giving a lift this morning to NVIDIA, which will be up 4 or 5% at the open. Again, markets are looking really good here. Now, we added to our short position yesterday simply because, this market has come very, very far, very, very quickly. And we do have two big reports tonight, which is Apple and Amazon, which are more consumer sensitive. So, there's a very good possibility that whatever gains we get today might be given up tomorrow, if those reports come out weaker than expected.
Well, here's another thing to think about. It seems like people talk some sense into Donald Trump when he was raging on about tariffs, when the markets were getting killed, and he kind of quieted down. But will he be more emboldened with markets feeling a lot better to kind of hold a tighter line with tariffs, with tariff negotiations, with retaliatory tariffs? So, that's just something else to consider.
No, and you say that, but, one thing that I've noticed more than anything else is you just haven't heard a lot about tariffs, right? I mean, there were supposed to be all these negotiation and deals going on with India, Japan, all these other countries, and you just kind of heard nothing. And this is kind of one of the things I said before is that once he kind of backed off those original tariffs from Lutnick and Navarro, that, he said, hey, we're taking a 90-day pause. And that helped heal up the markets, which he needed to do because we were on the cusp of something breaking when he did that. And that helped heal up the bond market, helped heal up the stock market, got things back under control. But, one of the things I said back then is I think he just doesn't say anything. I think just he's going to move on and we just don't hear much of anything. And maybe eventually down the road we'll hear like, oh, yeah, we cut a deal with India, whatever. But I think he's just going to move on. I don't think he's going to be coming back and saying, we're going to redo all these tariffs again because, again, the outcome, his approval rating on the economy is at 30%. So, I mean, it's had a very, very sharp drop in his approval on the economics. He pays attention to his ratings and the impact on the stock market. Well, they say he may not care about it. He cares about it because that's his donors. And so I think basically he just doesn't say anything. This just becomes a thing that goes on. And if he cuts a deal with somebody, then he'll announce that. But I don't think we're going back to tariffs where they were. I think after the 90 days comes and goes, just nobody mentions it.
Yeah, I think it seems like at least he's changing his kind of strategy, his public speaking strategy, and he's going to be quiet about it, which just serves the markets better. We don't need to know the ins and outs of every negotiation and what's going on and whether it's going good or bad. So I think that would be very helpful for the health of the markets here. And, we'll see over the next few months who gets, are there tariff deals? What do they look like? What happens after 90 days? Does he reinstate those tariffs or do we get another 90 days or 120 days?
I think he says nothing. I think he just says nothing and just lets it pass. So
could be.
All right, wraps up the show for today. We'll be back tomorrow. Richard Rosso will be here tomorrow. I will be in New York tomorrow. I'll be doing Charles Payne live in studio. There's no show tomorrow? No Richard tomorrow. Who's tomorrow? It's Richardless. So you're in for a treat tomorrow. It'll be a good show. So show up tomorrow. It'll be a good show. And then I'll be back on Monday. But I'll see you on Fox Business Live, 1 o'clock Central Time on Fox Business News tomorrow. So see you then. Bye.